Businesses often think of cash flow when it comes to invoicing and looking at what is in the bank. They also look at the terms they get from suppliers and those they offer to clients. The cash flow item they often miss is when borrowing. Take a standard commercial mortgage. It's pretty common for a borrower to look at the fixed rates to insulate against interest rate rises. They also look at the term to ensure the monthly outgoing is affordable. Affordable, based on the variables as they exist now. So how do you make a mortgage more cash flow friendly? Let's dispel one myth to start with. Interest only borrowing means only the interest is being paid. Therefore, the balance being borrowed at the outset remains the same when the loan matures. Or does it? Interest only borrowing is great. It keeps monthly outgoing down to a minimum and works well for cash flow. The downside is that the borrower is reliant on appreciation in property prices and the loan capital is never actually repaid. So how about interest only to keep the cost down and working well for cash flow, then making reductions to the loan as you go along? Most interest-only commercial mortgages include an allowance to overpay by circa 10% per annum. This means you're only obliged to make the interest-only payments, meaning cash flow is protected as best you can, plus when you have a surplus you can reduce the capital. Think of setting the capital reductions aside. Then use them to reduce the loan balance when it is safe to do so. Otherwise, keep the cash aside and just be better capitalised. Commercial mortgage borrowing with cash flow at front of mind. If you want to know more about commercial mortgage borrowing and want to know the best options for you, get in touch.